If you're tired of endlessly searching for a profitable forex trading strategy only to be left with disappointing results that look like this, then look no further. In this video, I'm going to reveal to you the new and improved version of a simple, tried and true swing trading strategy which has consistently generated profits for me and my students over and over and over again. So whether you're a beginner or an experienced forex trader, you definitely wouldn't want to miss out on this game-changing, simple and profitable forex trading strategy that works like gangbusters. Just grab a pen and paper, sit back, relax, and get ready to take your forex trading performance to a whole new level. So let's get started. So after taking a couple hundred trades with the trading strategy you're about to learn in this video on a $100,000 simulated forex trading account, this is what its equity curve looks like. I'm pretty sure you can see that this trading strategy has got a steadily rising equity curve, which is one of the key things any professional forex trader would be looking for in a consistently profitable forex trading strategy. And when we dig a little deeper into the performance stats of our swing trading strategy on this $100,000 forex trading account, you'll notice that it actually brought in a net profit of about 41.3% of this $100,000 account starting balance, even though it only had a 43.9% win rate for the 296 trades which were taken on the account, risking only 1% of the account starting balance on each and every trade which was taken. And this is simply because the average profit of the winning trades which were taken on this trading account are actually twice the size of its average losing trades. Another thing to pay close attention to is the fact that this swing trading strategy had a max consecutive wins of 14 trades and a max consecutive losses of 14 trades as well. Therefore, when you go about trading the markets using this forex trading strategy, you shouldn't get overconfident and disregard your risk management rules when you suddenly encounter a streak of 10 winning trades or more. Just like you shouldn't abandon it in search for the next best thing or a holy grail forex trading strategy as soon as you encounter a streak of 10 losing trades or more. Anyways, enough with the deep dive into the performance stats of this trading strategy. Let me quickly show you exactly how to find low-risk, high-probability forex trade setups using this simple and profitable trend-following forex trading strategy in a step-by-step manner. The forex trading strategy which you're going to learn in this video is made up of 5 simple steps. The first step in the strategy's low-risk, high-probability trade setup identification process is trend identification. The second step is trend confirmation. And right after that, we've got the third step, which is trade entry determination. The fourth step is stop loss identification. And last but not least, the fifth step is profit target determination. But in order to find profitable trade entry and exit points using the trend following forex trading strategy which I'm about to share with you in this video, we're first going to need to set up our price charts with the technical indicators which are going to help us to do just that. So let's go ahead and do that now. Okay, so as you can see on the screen, I'm currently inside MetaTrader. And the first 3 technical indicators which we're going to be adding to our price charts are going to be 60-period simple moving averages applied to prices high, low, and close. So let's go ahead and do that, okay? Click on the Inserts tab in the navigation menu, and then hover your mouse's cursor over the Indicators tab, and under the trend category of technical indicators, select the moving average. In this field where it says period, you want to type in 60, okay? And then under the MA method drop-down menu, you want to select simple. Under the apply to tab, you want to select close, okay? And then in this color palette, you want to select the color red, or you could color it whatever color you want, but I'm going with red for now, okay? So I'm going to be selecting a thick line here, the third line in this drop-down menu, to make this line stand out, this moving average, to make it stand out, okay? And once I'm done with all of this, I'm going to click on the OK button. And that's it. You see, we have our first 60-period simple moving average, which is applied to prices close, okay? Now we're going to do the same thing one more time. Actually, we're going to be doing it twice, but let's go on with the second time now. Click Insert, hover your mouse's cursor over Indicators tab. Under the Trend category of technical indicators, select Moving Average again. we're going to leave this set to 60, the period. We're going to leave it set to 60. But the only difference now is we're going to be changing this, the apply to, okay? Under the drop down menu, we're going to select high. And under the styles tab, I'm going to be coloring it black, okay? You could go with whatever color you want. Now to make this lines different, okay? This 60 period, which we're going to be applying to prices high, to make it stand out from the other line which we added, this red one, I'm going to be selecting this thin line here, and then in the drop down to its left, to the left of the line we selected, I'm going to be selecting this dotted lines, okay? And once I'm done with this settings, I'm going to click on the OK button, okay? And that's it. We have it again on our charts, okay? So this is the 60 period simple moving average applied to prices high. We're going to do the same thing again. Select insert, indicators, trend, and moving average. But this time around, it's still the simple moving average, but this time around, we're going to be selecting prices low, okay? And we're going to leave the settings as is. So this dotted lines is going to look like a dotted line again. Click on the OK button, and we have our 360 period simple moving averages on our price chart. This trend following Forex trading strategy uses multiple time frame analysis to identify and confirm the direction of the prevalent trend for any currency pair within the foreign exchange markets. It also capitalizes on multiple time frame analysis to find super low risk, high probability trade entry and exit points on the lower time frame charts of whichever Forex currency pair you decide to use it to trade with. In the first step of this trend following Forex trading strategy's low risk, high probability trade setup identification process, you're going to learn how to determine Forex trend direction for any currency pair you wish to analyze within the global spot Forex markets. Now, in order to successfully accomplish this task, we're going to be using the daily time frame of whichever currency pair we wish to trade within the spot Forex markets. Whenever price successfully crosses and closes above the 360 period simple moving averages on the daily time frame of any currency pair, we're going to conclude that the overall direction of the trend on that currency pair is a bullish trend according to this strategy's rules. On the flip side, if price crosses and closes below the 360 period SMAs on the daily time frame of the currency pair we wish to trade, we're going to arrive at the conclusion that the direction of the trend on that particular currency pair is bearish, just like the examples which you're seeing on my screen right now. In this step of the process, you're going to learn how to confirm a trend in Forex trading using multiple time frame analysis. Now, in order to successfully accomplish this task, we're going to be using the 4-hour chart of the currency pair which we would like to trade. If the direction of the trend is bullish on the daily time frame of the currency pair which we would like to trade, then we would also like to see a bullish trend on the 4-hour time frame of that currency pair in order to confirm that the direction of the trend is actually bullish. On the other hand, if the direction of the trend on the daily time frame of the currency pair which we would like to trade is bearish, then we would also like to see a bearish trend on the 4-hour chart of that currency pair in order to confirm that the direction of the trend in the market is actually bearish. So for example, assuming that the direction of the trend on the daily time frame of this particular currency pair is bearish, it's actually safe for us to say that the direction of the market's overall trend is bearish at the moment, since the direction of the trend on this currency pair's 4-hour chart is also bearish. And in case you've forgotten, the reason why we arrived at the conclusion that the direction of the trend on this particular currency pair's 4-hour time frame is bearish is simply because price has successfully crossed and closed below the 360 period SMAs on the currency pair's 4-hour chart. On the flip side, if the direction of the trend on the daily time frame of this currency pair was bullish, we would have wanted to see a bullish trend on its 4-hour chart before we would conclude that the direction of the pair's overall trend is actually bullish at the moment. So I just showed you how to identify the direction of the long-term trend of any currency pair using its daily time frame. And I also showed you how to confirm the direction of that trend using the 4-hour time frame of that same currency pair. The reason why we're doing this is simply because when a trend is moving in the same direction on the daily time frame and the 4-hour time frame of any currency pair, the probability that price is going to continue moving in that direction is much higher than the probability of price moving in the opposite direction. And profitable Forex trading is nothing but a game of probabilities. This is why one of the first signs which will let you know that a trend is either pausing or coming to an end is when the direction of the trend on the higher time frame and the lower time frame of the currency pair which you're analyzing have stopped moving in the same direction. In fact, this is one of the most common methods professional trend traders use to know when a trend is ending. Since you've now learned how to identify and confirm the direction of the trend of a currency pair within the foreign exchange markets, the next step in the process is to learn exactly how to find trade entry and exit points in the direction of the market's prevalent trend. And that is exactly what I'm going to be showing you how to do in this step of our trend following forex trading strategies low risk, high probability trade setup identification process. FX Mindtricks Academy's trend following forex trading strategy uses the 1 hour time frame of any currency pair to find low risk, high probability trade entry and exit levels within the forex markets. But according to the rules of the strategy, we're only allowed to arrive at this step of the process if the trend on the daily time frame and the 4 hour time frame of the currency pair which we would like to trade are both moving in the same direction. To put it in simple terms, the first and second steps of this trading strategy's trade setup identification process were actually put in place to give us a big picture view of what's actually going on within the foreign exchange markets. If you could remember, in step number 1, we were expected to identify the direction of the trend within the foreign exchange markets, and in step number 2, we were actually required to confirm that the direction of the trend on both the daily and the 4 hour charts of the currency pair which we would like to trade are both moving in the same direction. So for example, if the direction of the trend on the daily time frame of a currency pair is bullish and the direction of the trend on that same currency pair's 4 hour time frame is also bullish, we're only going to be looking for long trade setups on the 1 hour time frame of that currency pair. On the contrary, if the direction of the trend on the daily chart of any currency pair is bearish and that bearish trend is confirmed by a bearish trend on the 4 hour chart of that same currency pair, we're only going to look for short trade setups on the 1 hour chart of that particular currency pair. However, if the direction of the trend on the daily time frame of a currency pair is bullish and the direction of the trend on the 4 hour time frame of that same currency pair is bearish, we're not allowed to crank down to the 1 hour chart of that currency pair to look for forex trade setups. In the same vein, if the direction of the trend on the daily time frame of a currency pair is bearish and the direction of the trend on the 4 hour chart of that same currency pair is bullish, we're not going to look for trade setups to take advantage of on the 1 hour time frame of that currency pair. So to put it in simple terms, no trend alignment, no trade. It's really that simple. Now that we've extensively talked about exactly what needs to happen before we will be allowed to move down to the 1 hour time frame of any forex currency pair to look for low risk, high probability trade entry and exit levels for our forex trade setups in the direction of the market's prevalent trend, let me quickly show you how to find high probability trade entry levels in the direction of that trend. As you can see on the screen, we're going to need to use the fractals indicator in order to successfully accomplish this task. The fractal indicator is going to make it a lot easier for us to identify swing highs and swing lows on the price charts of the currency pairs which you would like to trade during trending foreign exchange market conditions. So for example, on the chart which is being displayed on the screen now, our short trade entry level is going to be the lowest price level of the most recent confirmed swing low on the 1 hour time frame. And according to the fractals indicator, the most recent confirmed swing low on this 1 hour chart is the most recent candlestick which had a down fractal printed below it and 2 fully formed candlesticks after that swing low was formed. Now, since the market's current price is usually going to be a couple of pips away from our ideal short trade entry level, we could just use a sell stop pending order to get us into the market with a short trading position when price reaches it, in line with the trade setup identification rules of this simple and profitable trend following forex trading strategy. However, during uptrending market conditions, the trade entry levels for the long trade setups which we're going to identify using this forex trading strategy are going to be the highest price levels of the most recent swing high on the 1 hour time frame of the currency pair which we would like to trade with it. In an uptrending market, the most recent swing high on the 1 hour chart of a currency pair is going to be the most recent candlestick which had an up fractal printed above it and 2 fully formed candlesticks after that swing high was formed. Therefore, in the case of an uptrending market, we're going to be looking for up fractals on the 1 hour time frame of the currency pair which we would like to trade, because they're going to make it easier for us to find the most recent swing highs, which we will be using to identify the trade entry levels for our long trade setups. If there's no trend alignment between the daily chart and the 4-hour chart of the currency pair which we would like to trade, we're simply not going to crank down to their 1-hour charts to start looking for Forex trade setups according to the rules of this Forex trading strategy. I almost forgot to mention that just as we would like to see that the trend is moving in the same direction on the daily and the 4-hour charts of a currency pair before we would proceed to start looking for Forex trade setups in the direction of that trend on the 1-hour time frame, we are not going to proceed to finding entry and exit points for Forex trade setups if the direction of the trend on the 1-hour time frame is not in alignment with the direction of the trend on the daily chart and the 4-hour chart of the currency pair which we are looking to trade. Put simply, the direction of the trend needs to be the same on the daily time frame, the 4-hour time frame, and the 1-hour time frame of any currency pair which we would like to trade before we can proceed to finding trade entry and exit levels in the direction of that trend on the 1-hour time frame. So to do a quick recap, in step number 1, I showed you how to determine Forex trend directions. In step number 2, I showed you how to confirm a trend in Forex, and in step number 3, I showed you how to identify the exact price level where you should be getting into the foreign exchange markets with a trading position during both bullish and bearish trending market conditions. In step number 4, you're going to learn how to identify the exact price level where you're going to be placing stop loss orders for the Forex trade setups, which you're going to identify using this trend following Forex trading strategy during trending market conditions. So let's get on with it, shall we? Now, in order to identify the exact price level where we are going to be placing the stop loss orders for the Forex trade setups, which we will identify using this Forex trading strategy, we're going to be using the 60-period SMAs applied to prices high and low on the 1-hour chart. So, moving on with our previous example, the stop loss order for the short trade setup which we identified is going to be placed at the price level where the 60-period SMA, which was applied to prices high, was located at right after we spotted the swing low, which we used to determine the trade entry level for our short trade setup. However, if price was trending to the upside on this particular currency pair, we would have used the 60-period SMA, which was applied to prices low, to determine the exact price level where we are going to be placing the stop loss order for our long trade setup. So in a nutshell, this Forex trading strategy uses the 60-period simple moving average, which was applied to prices high on the 1-hour time frame of a currency pair, for the purpose of identifying stop loss levels for the short trade setups, which we'll identify during bearish trending market conditions. On the flip side, this trading strategy uses the 60-period simple moving average, which was applied to prices low on the 1-hour time frame of a currency pair, for the purpose of identifying stop loss levels for the long Forex trade setups, which it identifies during bullish trending market conditions. So, since you now know the exact price levels where you're going to be placing your trade entry and stop loss orders according to the rules of this trend following Forex trading strategy, the next step in the process is to identify the price level where you're going to be placing your profit targets. You see, determining the price level where you're going to be placing the profit target for the long or short Forex trade setups, which you'll identify using this Forex trading strategy, is really simple. All you would need to do to get the exact price level where you're going to be placing the profit target for your Forex trade setups is to simply aim for a profit target which is twice the number of pips which you are risking on each and every trade you decide to take. So for example, if the distance between the trade entry level and the stop loss level of a Forex trade setup you identify is 50 pips, your profit target is going to be placed 100 pips away from that trade setup's trade entry level according to the rules of this trend following Forex trading strategy. Let me quickly show you exactly what I'm talking about using a practical example. Moving on with our short trade setup example, our profit target is actually going to be placed about 34.8 pips away from the trade setup's entry level, since the distance between its stop loss and sell stop pending order is only 17.4 pips. But instead of using a fixed profit target, which is going to close out the entirety of our trading positions when price reaches their predetermined profit targets, this trading strategy uses an advanced scaling out technique which was put in place to help us capitalize on those times when price would just blow past our profit target and keep moving in our favor for a huge amount of pips. Using a scaling out technique like this one would help you to remain disciplined, since it's going to drastically reduce the likelihood of taking revenge trades out of anger whenever you see price blow past your profit target, as you sit there and agonize over how much more profits you would have made if only you held on to your trading positions. Here's an example of exactly what I'm talking about. So in order to successfully use the scaling out technique, you're going to need to take 2 trading positions. But don't worry, because both of these trading positions are only going to amount to a 1% risk on your trading account starting balance. So if, for example, all you're allowed to risk based on your trading plan is 1% of your trading account starting balance, then the way you're going to work this is you're going to divide your trading position, the risk you're going to take, into 2 trades. So for the first trade, you're actually going to be risking 80% of your max risk per trade. And on the second trade, you're going to be risking the remaining 20%. So what I did here is, you can see that I've placed this short trade setup, which we've been using as an example. On this account, I'm only allowed to risk 1% of the account starting balance, which is $1,000. So what I did here was, for the first trading position which I took, this sell stop pending order, I was actually risking $800. That's 80% of the trading position, the max risk per trade, which I'm allowed to risk. And that 80% of the trading position, it actually has a profit target. So if price was to reach this profit target, I'm actually going to be making 2 times what I'm risking on this trade. But for the second 20% of the remaining position, I'm actually not having any profit target. The reason is because if price decides to move past my profit target to keep moving in my favor, I'm actually setting myself up to capitalize on that. So we have both of these trading positions set, and if price decides to hit the profit target for my large trading position, I'm actually going to move the stop loss of this second trading position to its trade entry level, so that I'm not going to be losing anything on the trade, even if price was to reverse against it. Anyways, let's just move on with the trade example. As you can see, I'm going to be advancing this candlestick in this simulation, 1 candlestick at a time. Right as I clicked on it, the next candlestick triggered this trading position. We got into the market with this trading position. Again, a quick recap. Price is in a downtrend because price is trading below all of these 3 60-period moving averages on the daily time frame of this currency pair. Again, this downtrend has been confirmed by the 4-hour chart because price is also trading below all of these 3 60-period simple moving averages on the 4-hour time frame. And now price is also trading below all of these moving averages on the 1-hour time frame. So we waited for the formation of a down fractal. We had one form here, but price never triggered it. So when price formed a brand new down fractal, we placed our sell stop pending order here and moved our stop loss up until the price level where the 60-period simple moving average, which was applied to price's high, was located at. That's how we got here in the first place. Instead of moving 1 candlestick at a time on the 1-hour time frame in this simulation, I'm going to be moving at 1 4-hour candlestick. And just like that, price has hit our profit target for the first trading position. So now when I go back to this trade, you can see that the first trade is not here because it's actually hit our profit target. So for the second trading position, what we're going to be doing is we're going to be moving its stop from the initial stop loss level to break even. That's what we've done now. So we're going to keep holding on to this trading position up until the time that price is going to reverse and cross and close above this 360 period simple moving averages on the 1-hour time frame. When that happens, we're going to close this trading position. If that doesn't happen, then the only thing that would make this trading position close is if price reverses and hits its break-even stop loss to get us out of the market. We're moving 1 4-hour candlestick at a time. You can see that price is just moving in our favor. We've almost reached around 5 hours of what we are risking on this trade in profits. But this is not realized, it's just floating profit because we are still waiting for price to reverse and close in the opposite direction of the moving averages before we are going to decide to close this trading position. Now just imagine that you are actually in this trading position and you took only a 2-hour profit. You can see the reason why this is going to be very hard for you if you just get out of the market with a 2-hour profit, because as you sit and see this, you're going to be thinking to yourself, if only you didn't close the trade, all of those kind of thoughts would be going through your head and you would want to break the rules of your trading strategy or your trading plan, which would only result in ginormous losses, okay? Again, price is moving in our favor way past the 5-hour mark. And just like that, we now have a reason to close this short trading position because price has crossed and closed above this 360 period simple moving averages on the 1-hour time frame. So this is our cue to get out of this trading position right now with more than 10 hours in profits on the second trading position, the smaller one, the 20% one, which we left open. And don't forget that we also took profits on the larger part of this trading position when price reached its 2-hour profit target. So you can see we have almost a 12-hour profit on this trade, which we're going to close right now. This is how we capitalize on the times when price would blow past our profit target and just keep moving in our favor. And one more thing I forgot to mention is, even if price was not to hit our profit target or our stop loss, but after we got triggered into the trade, price decided to cross and close in the opposite direction of the moving averages on the 1-hour time frame, we're going to close that trading position. That's another exit rule based on the rules of this trading strategy. So you've just seen an example of a short trade setup which was taken according to the rules of this trading strategy. Now I'm going to be showing you the example of a long trade setup which is going to be taken based on this same trading strategy's rules, okay? So first things first, you can see that the direction of the trend on the daily time frame is actually bullish because price is trading above this 360 period simple moving averages on the daily time frame. This bullish trend has now been confirmed by the trend on the 4-hour time frame because price is also trading above this 360 period simple moving averages on the 4-hour time frame. And the final step is to actually determine the direction of the trend on the 1-hour time frame before we can move on to identify low risk, high probability long trade setups in the direction of this bullish trend. This is also giving us the green light because price has crossed and closed above the 360 period simple moving averages on the 1-hour time frame. But one thing to bear in mind is that this up fractal, which we're going to be using to identify our trade entry level, hasn't been confirmed yet because we only have one candlestick closing after the up fractal was formed. So if price was just to decide to shoot up right now, this fractal is actually going to disappear from here. So we don't want to be using disappearing indicators when we're actually trading a strategy. And that's the reason why we wait for one more candlestick to close at the right hand side of the fractal, which is indicating the swing high in this example. And that's going to confirm that this fractal is not going to get repainted. It's not going to disappear. And this has just happened because right after I clicked on the next 1-hour candlestick, you can see that the price of that candlestick never took out this highs. And as a result of that, this fractal is a confirmed fractal. It's not going to repaint. So now we have the fractal, which is showing us the swing high, which we're going to use to identify our trade entry level. So how do we identify our stop loss? Well, if you remember, we used this 60 period simple moving average, which was applied to either prices high in the case of a downtrending market for our stop loss determination, or in the case of an uptrending market, we used the 60 period simple moving average, which was applied to prices low. So in this case, we now have what we would need to determine our trade entry level, where we're going to be placing our buy stop pending order, and our stop loss level. So our trade entry level is the highs of this candlestick, this swing high, which the up fractal was printed upon after all of the other conditions were met. And our stop loss is going to be this price level where the 60 period simple moving average, which was applied to prices low, is at the moment when we identify the trade setup. So we're actually going to keep moving this stop loss if price doesn't trigger our trade entry and it keeps moving up. So now we're actually going to adjust this because our stop loss is going to be at the 144.66 price level. And our trade entry level, that's our buy stop pending order, is going to be placed at the 144.94 price level. So let's quickly place this. Remember, we're using two trading positions. The first trading position, we're going to be placing 80% of that trading position. We're still risking 1% of our trading account capital. It's just that 0.8% of that 1% is going to be placed on the trade which has a profit target. And the remaining 20% of that trading position is not going to have a profit target so that we can ride the trend if price decides to keep moving in our favor. We're going to place our buy stop pending order 144.94. Our stop loss is going to be placed at the 144.66 price level, and our profit target, which is 2 times the distance between our trade entry level and our stop loss, is going to be placed at the 145.50 price level, and that's why we have a stop loss of 28 pips and a profit target of 56 pips, which is 2 times that amount. So this is our first trade. Now for the second trade, which is going to be risking $200, we're going to actually place the buy stop pending order but without a profit target. So our trade entry level is going to go to the 144.94 price level. Our stop loss is going to be placed at the 144.66 price level. And it doesn't have a profit target because we want to capitalize on those times when price will continue moving in our favor, okay? So let's see how this trade would have panned out. Again, you can see that this trade has been triggered. Instead of moving one hour candlestick at a time, I'm going to switch the simulation time frame to 1 4-hour candlestick at a time. So let's keep moving and see how this trade would have panned out. Okay, you can see that price has just hit our profit target for the first trade, and the second trade is currently in floating profit. So we're going to move our stop loss from its initial position to break even, so that even if price was decide to reverse against this trading position to come back to its trade entry level, we're not going to lose anything from this trading position. In fact, we've just made money from it because 80% of that trading position has been closed out when price reached 2 times what we were risking on the trade. Okay, so now we're just going to be moving with the trend and see how much the market is going to decide to give us on this trading position as a profit. Okay, so you can see that price is way past the 5-hour mark and it's still moving in our favor because it hasn't crossed and closed in the opposite side of the 360 period moving averages on the 1-hour time frame for this currency pair. Okay, we're still holding on to this trading position up until this moment. You can see that price has now crossed and closed below this 360 period moving averages on the 1-hour time frame. So this is our signal to close up all of our trading positions and take our profits. Okay, you can see that we've made a little over 6R on this remainder of this trading position. This is on top of the profits we made on the first portion of the trading position, which had 80% of it close when price reached its 2-hour profit target. So we're going to close this trading position with a profit. You can see that we've closed it with a very, very handsome profit. But I must warn you, even if you've got a proven, profitable Forex trading strategy, such as the one which I just revealed to you in this video, you're going to find it extremely difficult to make money through Forex trading if you fail to practice sound risk and money management. What do I mean? Well, let's assume that immediately after watching this video, you went and found yourself a reputable Forex trading broker and you funded your Forex trading account with $1,000 of your hard-earned money so that you could try out the strategy within the live Forex markets. And playing by the rules of the strategy, you made up your mind to risk no more than 1% of your Forex trading account's capital on each and every trade which you decide to take. And since this Forex trading strategy only allows us to take trades which will bring in profits that are twice the amount of money which we're willing to risk on each trade we decide to take, you will be earning a profit of about 2% of your trading account's capital from your winning trades. So for simplicity's sake, let's say you took 5 trading positions using this trend following Forex trading strategy. 4 of them were winning trades and 1 of them turned out to be a loss. With 4 wins and 1 loss, your win rate is going to be about 80%. And in Forex trading, that is a ridiculously high win rate percentage. But in this example, the high win rate of your Forex trading strategy didn't translate into profits in your Forex trading account. And that is simply because instead of risking only 1% of your Forex trading account's capital on each one of the trades you took, you got overconfident after that 4th consecutive winning trade which you took, and so you decided to bet the farm. You decided to risk 10% of your Forex trading capital on that 5th trade. You did that because you were in such a rush to double your Forex trading account's capital. I mean, everyone else seems to be doing that same thing on YouTube, isn't it? But lo and behold, your 5th trade using the Forex trading strategy turned out to be a losing trade, causing you to incur a staggering loss of about 10% of your trading account's capital. Now on the surface, your Forex trading performance stats are going to say that you've got a whopping 80% win rate. However, after digging in a little deeper, it'll be discovered that your Forex trading account is down by about 2% when we subtract the 8% gross profit which you earned from your 4 winning trades from the 10% gross loss which you suffered from your oversized losing trade. In this example, the strategy did pretty well. However, you still ended up losing money as a result of poor risk management and your inability to follow your Forex trading strategy rules. This is why you'll hear professional Forex traders often saying that proper risk management is much more important than Forex trading strategies. But let's quickly take a look at a completely different scenario where we're going to use the high risk to reward ratio of our Forex trading strategy to our advantage. Let's assume that you followed the risk management rules of our Forex trading strategy and you only risked 1% of your trading account's capital. You still took 5 trades in this example, however, things weren't as smooth as they were in the previous example which I gave you a couple of seconds ago. This time around, you lost 3 trades and you had only 2 winning trades. As a result of this, your win rate worked out to be about 40% in this example. However, since all of the trades which you took had a 1:2 risk to reward ratio, you ended up earning a gross profit of about 4% of your Forex trading account's capital from your 2 winning trades, and you only suffered a gross loss of about 3% of your trading account's capital from your 3 losing trades. Therefore, you still ended up with a 1% return on your trading investments, even though you only had 2 winning trades and 3 losing trades in this example. This wouldn't have been possible if the profits from your winning trades were not twice the size of the losses from your losing trades. And this is why it is very important for you to never take the profits from your winning trades too early. Don't worry about price reversing against you and hitting your stop loss order, even if it was only 1 pip away from hitting your profit target. Trust me, in Forex trading, no matter what you do to prevent this, it is inevitably going to happen. However, if you stick to the rules of this Forex trading strategy, risking no more than 1% of your Forex trading account, and you allow your winning trades to hit their profit targets and your losing trades to hit their stop losses, more often than not, you're going to end up making money after you must have taken at least 100 trades. This is how this game works, guys. It's really that simple. Therefore, if you would like to make money through Forex trading using the trend following Forex trading strategy which I just taught you in this video, you should never risk more than 1% of your Forex trading account's capital on each and every trade which you decide to take. But the thing is, even if you have the best Forex trading strategy in the world and it generates winning trades 95% of the time, you're still going to struggle to squeeze profits out of the Forex markets on a consistent basis if you don't know exactly what to do as well as how to think and act like a consistently profitable Forex trader. And that's why you absolutely need to watch our Profitable Forex Trading Blueprint series, which is a crash course designed to help you become a consistently profitable Forex trader in a step-by-step manner. Just click the video on the screen now to get free instant access to the crash course.